Okay, chapter 24, page 1217, we're going to start looking at accept business at a special price. And we're also going to talk about some selling pricing models. It's going to be page 1217 through 1225, and then we'll look at basic exercise 24.6 and 24.7 on page 1243 at the end of the video. Okay, so it's not uncommon, and I realize I keep saying that apparently, but businesses often need to fill excess capacity and excess space, especially at year end if they're not doing as well or the economy's down or things like that. We could look for opportunities to sell our product for maybe less than what I typically sell it for. But we have to take into account the fact that it might be worth it for me to sell it at a lower price simply because it's additional on top of what I've already done for the year. And we also, again, need to look closely at cost relevancy and see, okay, what are relevant costs here to see whether I'm actually making money or not. Again, we're probably going to look a lot at fixed costs because fixed costs have already been our sunk costs at this point. So they're not really technically relevant in this situation. So we'll go through an example and show you what I'm talking about. So on the bottom of 1217, it says, to illustrate, assume B-Ball Incorporated manufactures basketballs as follows. Monthly product capacity is 12,500. They're currently selling $10,000 or 10,000 basketballs. The normal domestic selling price is $3 per basketball. Their variable cost is $12.50. Their fixed cost is $7.50. So the total manufacturer cost is $12 per basketball. On March 10th of the current year, B-Ball Incorporated received an offer from an exporter for 5,000 basketballs at $18 each. Production can be spread over 3 months without interfering normal production or incurring overtime costs. Pricing policies in the domestic market will not be affected. As shown in Exhibit H, or differential analysis to whether accept or reject the order. So rejecting the order, obviously we have no additional costs, no additional revenues. Accepting the order, this is why I kind of teach why I wanted to show you prior in the chapter that we just got rid of fixed costs, because in this case, instead of, the book kind of changes years here a little bit, which bothers me, but they just stopped showing fixed costs now. Technically, to do this, the differential analysis, the way they did the ones prior in the chapter, they should have showed fixed cost underneath the reject and accept, and then still maintain the same amount of differential income. But instead, what they did is kind of what I showed you earlier, and that is they took the revenues that they would earn and subtracted out only the variable cost and left off the fixed cost because, and this is correct, because the fixed cost does not change whether I accept or reject this offer to make or buy this. The example problem for this is brief exercise 24.6. I'm going to go try that on your own. You can pause the video and do that. I'm going to go through a little bit about pricing kind of quickly. There's a lot of pages on it, and I'm not planning on going in depth about it. So this one will go, these pages will go a little fast, but we will do one example problem on those next four pages or so. So looking at page 1221, we're talking about how we set our normal prices. Managers basically have two different methods of doing that. Demand-based, meaning of what people are willing to pay for the product and how they drive demand by higher or lower pricing, and competition. Okay, if there's other people out there selling similar products or products that do the same thing, then we would want to possibly look at what they sell it for. Now, that's more from the marketing and economic side. From the accounting side, we kind of we want to start kind of with our cost, okay? So this is an example where you're bringing in multiple areas of the organization to talk. You're not just using the accountants to figure this out, you're also using your marketing people, you're also using probably your upper level management because there are important decisions to be made, but all of you have valuable information for it. So managers use one of the three cost plus options for selling price: the product cost method, the total cost method, and the variable cost method. So the cost plus method, first of all, in the first place, is exactly what it sounds like: cost plus the markup. So if I want a 10% markup, it would be cost plus 10%. Now realize I can't just take it times 10% because that would reduce the number. So I need to increase it by 10%. So I need to take it times 10% and then add that back in, or whatever it might be. Whatever your method might be mathematically. So the product cost method is where you figure out the total product cost, that's direct materials, direct labor, and factory overhead. I'm on the bottom of 1222, 1222. and then divide the total product cost by the estimated units that are going to be sold. And then from that point, I would compute the markup percentage, desired profit plus the total selling and administrative expenses divided by the total product cost. This would be usually our desired return on assets. So then I determine the markup per unit by multiplying the markup percentage times the product cost per unit. So markup percentage times the product cost per unit, and then I would add that back in to get our normal selling price. So for example, we have this company on digital solutions. We have a total product manufacturing cost of 1.5 million. We have more selling and administrative costs. So our product cost is 1.5 million, selling administrative is 170. Step 3, total product cost is $15. And you get that from taking the $1.5 million total product cost divided by the total units. Then I would add my desired profit. In this case, desired return is 20%. So that would mean $160,000. By the way, that's a number that would just need to be reasonable. I mean, obviously, you'd want to put that as high as possible. At the same time, it needs to be something reasonable. Otherwise, you're going to price yourself out of the market. So what they found is our market percentage in order to attain that needs to be 22%, because now they're covering their fixed cost effectively too. So now $3.30 per unit would be their selling price. The next method is the target cost method, where I have my expected selling price, and this is usually taken from outside or competition-based method, minus my desired profit. So I want to basically kind of back into the number as far as what I want to make and what I expect to sell, and confirm that based on demand, based on what I believe I can sell, that I can reach my desired profit margin. Okay. So let's go look at 24.6 and 24.7. Okay, so 24.6 says accept special business or business at a special price. Product A is normally sold for $9.60 per unit. Special price of $7.20 is offered to the export market. The variable production cost is $5 per unit. Additional tariff of 15% of the revenue must be paid for all exports. Assume there's sufficient capacity. For the special order, prepare a differential analysis dated on March 16th of whether to reject or accept. So we have reject or accept. And first of all, revenues. If we reject it, revenues are 0. If we accept it, revenues are $7.20. As far as costs go, or variable cost per unit, which is 0. If I reject it, my export tariff is also 0 if I accept it. So really everything, I'm sorry, reject it. So really everything here is all about the accept. So I have the variable cost of $5 per unit and the tariff, which is 15% of the revenues. So 7.2 times negative 0.15, just to make it a negative number, gives me 1.08. So my difference is revenues increased by 720, my expenses increased by $5 and 108. So in sum, that is $1.12. So we should accept the special order. My income goes up by a total of $1.12. So now 24-7. Okay. 24-7 says Green Thumb Garden Tools produces and sells home garden tools. The lawnmower has a total cost. Lawnmower total cost of $230, of which 160 is 160 is product cost. And $70 is selling administrative. In addition to the total cost of $230, is made up of 120 in variable cost and 110 in fixed cost. Desired profit is $58. Oops, desired profit is $58 per unit. Okay. So from the formula we looked at, see here they're using the markup percentage. They want to know the markup percentage on product cost. So that formula, just so I can quote it exactly like I said, is desired profit. There it is on page 1223. Desired profit plus total selling and administrative expenses divided by total product manufacturing costs. So in this case, so let's check that out. Well, actually here, so equals desired profit plus selling and administrative expense divided by my total product cost. So the market percentage on product cost would be 80% in this case. And that's it for this video.